This LOS is describe implications of valuing inventory at net realizable value for financial statements and ratios. Evaluation of inventory management. The inventory turnover ratio, number of days of inventory, and gross profit margin ratio are useful in evaluating the management of a company's inventory. Inventory management may have a substantial impact on a company's activity, profitability, liquidity, and solvency ratios. It is critical for the analyst to be aware of industry trends and management intentions. Financial statement disclosures provide information regarding the accounting policies adopted in measuring inventories, the principal uncertainties regarding the use of estimates related to inventories, and details of the inventory carrying amounts and costs. This information can greatly assist analysts in their evaluation of a company's inventory management. So a quick review of the ratios and how some of the different choices with regards to inventory can impact them. So if we look first at the activity ratios, we know that we look at inventory turnover and therefore days of inventory and working capital. So again, if we're the choice of LIFO versus FIFO, for example, with FIFO we're going to have higher inventory because it's the LIFO inventory plus the LIFO reserve. We're going to have a lower turnover. And under FIFO we're going to have the higher inventory, so we're going to have more working capital. Again, with regards to liquidity, that's the ability to meet short-term liabilities. Under the different methods, we're going to have different inventory balances, so the current ratio is going to be different. The quick ratio and the cash ratio are going to be the same because we take inventory out of those two ratios. With regards to solvency, we saw that the choice between the LIFO and the FIFO, we're going to have different retained earnings, so therefore our debt to capital and debt to equity ratios are going to be different. With respect to profitability, we saw for LIFO cost of goods sold, for the FIFO cost of goods sold, it's the LIFO minus the increase in the reserve or the change in the reserve. So our gross profit was higher when prices were rising. We've gone through those examples in the different LOS, so we're going to have different profitability. And that's going to flow right through down to the net income and potentially the valuation. So in summary, inventories and the choice of method with regards to the costs can have a big impact on a variety of ratios, and that's why it's important to study and understand the differences. And that's the last slide for this LOS. Thank you.